Imagine you were the CEO of a multi-billion-dollar steel empire. You've basically dominated the market for a decade.
Right, sitting comfortably at the top.
Exactly. But suddenly, this really well-funded startup announces they're coming for your customers. So what's your next move? Do you try to, buy them out?
Or maybe try to out-innovate them, with better steel.
Right. Or do you purposely build this massive, incredibly expensive factory, staff it, power it up, and then just leave it entirely empty?
Just to terrify that startup into quitting before they even begin, it sounds insane.
It really does. But welcome to the deep dive. Today, we are decoding the cutthroat, totally game theory-driven world of industrial economics.
Yeah, it's a world where basic intuition just often fails, and where the most irrational-seeming behavior, like burning millions of dollars on an empty factory, is actually a mathematically perfect strategy.
Yeah, and for you, the listener, understand these mechanisms isn't just some academic exercise. We have a highly specialized mission today.
We really do. This deep dive is an intensive, targeted revision for your GE-03, Paper 3, at the DSE and JNU Masters level, specifically geared toward the IES General Economics exam.
So we are looking directly at the trajectory of recent IES exams to sort of set the stage for you. Specifically, the 2025 question demanded a really deep understanding of limit pricing.
And the 2024 paper zeroed in heavily on contestable markets.
Right, so the examiners are sending a massive, undeniable signal here. To ace these questions, you can't just rely on flashcards.
No, regurgitating definitions will not cut it. You have to prove that you understand the underlying logic, the causality, and, well, the exact strategic weapons incumbent firms use to defend their territory.
Which means we really need to build this up systematically. We're going to start in the foundational metrics, right? Like how we actually measure market concentration.
Exactly, using tools like the Herfindahl-Hirschman Index and Tobin's Q. And from there, we need to unpack the theoretical frameworks.
The ones that govern how regulators actually view these markets.
Right, specifically that tension between the structure-conduct-performance paradigm and the Demset's efficiency hypothesis.
And once we establish that theory, we'll look at the physical and strategic realities on the ground.
Yeah.
We're going to break down barriers to entry.
Both the structural ones, born of physics and technology, and the strategic ones that get deployed like literal weapons.
Yeah, which sets us up perfectly to decode those exact pricing strategies from that 2025 question. We'll cover Bain's model and the silos postulate.
Before finally finishing with the 2024 focus, which is Baumol's completely mind-bending theory of contestable markets.
Let's just dive right into the diagnostic tools, because before we can analyze how a firm behaves, we have to actually measure the environment it operates in, right?
Yeah, we're basically diagnosing market power. Like, if you were the Competition Commission of India, the CCI, and two massive firms want to merge, you need a mathematical way to prove if that merger will destroy competition.
And the oldest, probably most intuitive tool in the kit is the four-firm concentration ratio, or CR4.
Right. It is exactly as simple as it sounds.
Yeah, you just take the market shares of the top four firms, add them up, and you get a percentage. So if the top four firms control 80% of the market, boom, you have a highly concentrated oligopoly.
It is simple, yeah, but its simplicity is actually its fatal flaw. The CR4 gives regulators these massive blind spots.
Oh, so?
Well, it tells you absolutely nothing about the distribution of power among those top four firms, nor does it tell you anything about the remaining tail end of the market.
Okay, let's run the math on that to show exactly why it fails. Imagine market A, where you have four firms that each control 20% of the market.
Okay, so 20 plus 20 plus 20 plus 20, that's a CR4 of 80.
Right. Now imagine market B, where one single behemoth firm controls 77% of the market, and three tiny firms control 1% each.
77 plus 1 plus 1 plus 1. That is also a CR4 of 80.
And those are two wildly different competitive landscapes.
Completely different. Market A is this fiercely competitive oligopoly where four heavyweights are just constantly fighting for margin.
Well, market B is basically an unchecked monopoly with, three gnats flying around it.
Exactly. Yet the CR4 treats them as completely identical. This is exactly why modern competition authorities rely on a much more sophisticated tool, the Herfindahl-Hirschman Index, or HHI.
And the HHI fixes that blind spot through one really specific mathematical trick. It squares the market share of every single firm in the industry before summing them up.
Yeah, we need to look really closely at the mathematical intuition behind that squaring, because that is what makes the HHI so brilliant.
Because squaring heavily penalizes variance and inequality.
Yes. It forces dominance to reveal itself. Let's use your Market A and Market B examples. In
Mhm.
Market A, with 4 firms at 20% each, you score 20 to get 400.
And 4 times 400 gives you an HHI of 1,600.
Right. In regulatory terms, anything between 1,500 and 2,500 is considered moderately concentrated. It warrants observation, but it's not a red alert.
But then when we apply HHI to Market B, the one with that 77% behemoth, the picture completely changes.
Oh, dramatically. We square 77 and instantly hit 5,929.
And then we square the 3 1% firms and get 1 each, bringing the total HHI to 5,932.
Which just rockets past the 2,500 threshold. That is the universal red line signaling a highly concentrated, potentially dangerous market. The dominant firm's weight was mathematically magnified by that squaring process.
That makes total sense. So to put this in an exam context, if you get a question on HHI, you shouldn't just define it, right?
No, absolutely not. You should walk the examiner through a merger calculation.
Like give them a hypothetical.
Yeah. Imagine a telecom market with 5 firms, each holding a 20% share. The pre-merger HHI is 2,000. That's 20 squared times 5.
Okay, got it.
Now imagine 2 of those firms merge. You now have 1 firm with 40% and 3 firms remaining with 20%.
So the new HHI is 40 squared, which is 1,600, plus 3 times 20 squared, which is 1,200.
Exactly. So the post-merger HHI is 2,800.
Wow. And regulators, they don't just look at the final number, do they? They look at the delta, right? The change in the HHI.
Correct. The delta in this specific case is 800 points. In U.S. antitrust guidelines and similarly in Indian contexts, an HHI increase of more than 200 points in a highly concentrated market creates a legal presumption.
A presumption that the merger will enhance market power and likely be anti-competitive.
Yes, that is exactly the kind of practical application you need to demonstrate on paper 3.
But wait, HHI only measures the structure of the market, right? Like how the pie is divided up.
Yeah, just the structure.
It doesn't actually measure the firm's behavior or, how much they are gouging the consumer.
No, it doesn't. To measure the actual execution of monopoly power, we need the Lerner Index.
Okay, so the Lerner Index quantifies the firm's ability to mark up its price above the competitive level. And the formula is price minus marginal cost, all divided by price.
Yes. Let's ground this with an example. Think of a perfectly competitive market, like a local farmer's market, where 50 people are selling identical tomatoes.
Right, so a firm there is just a price taker.
Exactly. If the market price is $2 a pound and their marginal cost to grow that extra pound is $2, price equals marginal cost.
2 minus 2 is 0. Divided by 2, still 0. So the Lerner Index is 0.
But a monopolist or a dominant firm in an oligopoly faces a downward sloping demand curve. They can deliberately restrict output to drive the price up.
Like a pharmaceutical company that holds a patent on a life-saving drug, their marginal cost to produce 1 extra pill might be like $1.
But they can charge $100 for it. So 100 minus 1 divided by 100 gives a Lerner Index of 0.99.
Wow. So the closer the index is to 1, the more monopoly power the firm is actively exercising.
Precisely. And the exam might also try to throw a curveball by bringing in Tobin's Q.
Oh, right. How does Tobin's Q fit into measuring market power?
Well, Tobin's Q is a more financial metric, but it is deeply relevant to industrial economics. It's the ratio of the market value of a firm's assets to the replacement costs of those assets.
So if a firm's Tobin's Q is significantly greater than 1, it means the stock market values the company far higher than what it would cost to literally rebuild its factories and buy its inventory from scratch.
Exactly.
But why would the market value them so highly if their physical assets aren't worth that much?
Because of intangible assets and, crucially, monopoly rents. If a firm has an entrenched monopoly position, the market is basically pricing in decades of future supernormal profits that no competitor can steal.
Ah, I see. So a persistently high Tobin's Q is often used by economists as a proxy for sustained market power and the presence of high barriers to entry.
You nailed it.
Okay, so we have a pretty solid toolkit now. HHI and CR4 measure the structure. Lerner measures the pricing power conduct. And Tobin's Q measures the financial performance of that power.
Which flows just seamlessly into the grand unified theory of early industrial organization, the structure, conduct, performance paradigm.
Right. The SCP paradigm, pioneered by Edward Mason and Joe Bain at the Harvard School back in the 1950s.
The SCP paradigm was the absolute bedrock of antitrust policy for decades. It posits a strict, causal chain.
It argues that the structure of the market, meaning the concentration we just measured with HHI, along with product differentiation and barriers to entry, directly dictates firm conduct.
And conduct is basically the firm's playbook. It's their pricing strategies, how much they spend on advertising, their research and development.
Like whether they actively compete or tacitly collude.
Yes, and that conduct, in turn, strictly determines market performance.
Which is evaluated in terms of allocative efficiency, like are resources going where consumers value them most?
Right, as well as technical efficiency, consumer welfare, and overall profitability.
So under the SCP paradigm, structure dictates conduct, and conduct dictates performance. It is this rigid, one-way street.
High concentration inevitably leads to collusive or monopolistic conduct, which inevitably leads to poor performance, high prices, and massive welfare loss for the consumer.
That was the accepted wisdom.
Yep.
And it gave regulators a very clear, almost mechanical mandate.
Yeah.
Like if you see a highly concentrated market structure, just break it up.
Exactly. You didn't even need to prove that the firms were acting maliciously. The structure itself was assumed to be toxic.
But we really have to look critically at that assumption. I mean, if the SCP paradigm assumes high concentration automatically leads to bad conduct and poor performance, are we just punishing companies for being successful?
That is the big question.
Like, what if a market is highly concentrated simply because one company is just drastically better at making a product than everyone else?
You have just articulated the central thesis of the Demsetz efficiency hypothesis. Yeah, that formed the battering ram of the Chicago School critique in the 1970s and 80s. Harold Demsetz looked at the SCP paradigm and argued that the Harvard School had the causality completely backwards.
He flipped the one-way street.
He did. Demsetz argued that high concentration does not inherently mean firms are engaging in anti-competitive conduct. Instead, high concentration might reflect superior efficiency.
So imagine a market with 50 competing firms. One of those firms invests heavily in R&D and develops a radically superior, highly efficient production process.
But their costs just plummet. They pass some of those savings onto the consumer in the form of lower prices, and they expand their output.
Naturally, consumers flock to them. The inefficient firms go bankrupt or get bought out. And over time, that market structure consolidates from 50 firms down to like 3 or 4.
Exactly. The firm grew larger and concentrated the market because it was more efficient, not because it was abusing its power.
Wow.
Therefore, if a regulator steps in and breaks up that concentrated firm based on the old SCP paradigm, the regulator is actually penalizing efficiency.
And harming consumer welfare by forcing production back into the hands of less efficient firms.
Exactly. This is the concept of reverse causality. High performance drives structural change.
Okay, but it is crucial for exam purposes that you don't present the Demsetz critique as the correct view and SCP as the wrong view.
Right. They are competing lenses. Today, we recognize that industrial organization is really a dynamic feedback loop. Structure influences conduct, conduct drives performance, but performance also reshapes structure.
It's a whole ecosystem. But wait, if we accept the Demsetz view that efficient firms naturally swallow the market by making massive profits, we run into a logical wall.
Which is?
Well, if a firm is making supernormal profits because of an efficient process, why wouldn't a dozen venture-backed startups just reverse engineer that process and jump to the market tomorrow? Like, what is physically stopping them?
That is the perfect question, and it transitions us from the measurement of the market to the physical realities of the industry. What stops them are the barriers to entry.
Ah, the walls of the castle.
Exactly. If our first topic was the blueprint of the market, this topic is the walls. And the fundamental determinant of market structure, like the deepest foundation of those walls, is MES, minimum efficient scale.
Let's break down MES. It sounds like jargon, but it's highly practical. It's basically the level of output at which a firm reaches the lowest point on its long-run average cost curve.
It's the sheer size you must achieve to be cost competitive in an industry.
And to truly understand how MES dictates market structure, we need to look at the ratio of MES to total market demand, right?
We do. Let's use a tangible industry. Think of a major steel manufacturing plant. You can't just build a boutique artisan steel plant in your garage and hope to compete on price with global conglomerates.
Yeah, the core technology requires massive blast furnaces, heavy continuous casting machinery, and immense dedicated power grids. The fixed costs are astronomical.
Let's apply hypothetical numbers to make this really concrete. Say the total market demand for steel in a specific region is 10 million tons per year. Because of those astronomical fixed costs, a steel plant cannot reach its lowest average cost per ton until it is producing 3 million tons a year. That is its minimum efficient scale.
So the MES is 3 million tons, and the total market demand is 10 million tons, which means the MES requires an output equal to 30% of the entire market demand.
The math there is unforgiving. If one efficient firm needs 30% of the market just to survive, the market can support, at absolute most, 3 efficient firms.
Maybe a fourth firm squeezing by at 10%, but they'd likely be operating at a slight cost disadvantage.
Right. If a fifth firm tries to raise capital and enter, there literally isn't enough remaining market demand for them to reach that 3 million ton threshold without massively oversupplying the market.
Which would drive the price of steel down below the cost of production for everyone. It would just be financial suicide.
Notice what has happened here. The technology itself, the thermodynamics of a blast furnace and the economies of scale, has created a concentrated oligopoly.
It is a structural reality. It's not inherently anti-competitive behavior.
No one is colluding in a smoke-filled room. It is just the physics of making steel. This is the very definition of a structural barrier to entry.
So structural barriers are the steep mountain the castle is built on. It's nobody's fault. It's just really hard to climb.
Yeah.
And aside from massive capital requirements and economies of scale, another huge structural barrier in the modern economy is network effects, isn't it?
Oh, absolutely. Network effects occur when a product or service becomes more valuable to its users as more people use it.
Like a social media platform or a telecommunications network. They have immense structural barriers because a new entrant cannot offer a valuable product on day one if they have 0 users.
Regardless of how good their underlying technology is, the incumbent's massive user base acts as a giant moat.
Another one would be switching costs. Like if enterprise software takes 2 years and $50 million to integrate into a hospital's IT system, that hospital is highly unlikely to switch to a new startup software, even if it is 10% cheaper.
The sheer cost and friction of switching is a structural barrier protecting the incumbent.
But incumbent firms don't just sit back and rely on the mountain to protect them, do they? They actively defend the castle.
They build their own walls. And this brings us to strategic barriers to entry. This transitions us from the structure of the market to the conduct of the firm.
So structural barriers are the steep mountain. Strategic barriers are the incumbents actively pouring boiling oil off the ramparts.
That captures the intent perfectly. Strategic barriers are deliberate, man-made obstacles created by incumbents solely to deter entrants.
And understanding how these work is the key to answering the 2025 IES question on limit pricing. We're moving deeply into strategic conduct now.
Let's talk about the exact pricing weapons a firm uses to deploy that boiling oil. Let's look at Bain's limit pricing model.
Typically in basic microeconomics, we assume a monopolist wants to maximize their profit right now, in the short run. They find the point where marginal revenue equals marginal cost, and they charge the highest price the demand curve will bear.
The short-run monopoly profit-maximizing price.
Right. But Joe Bain recognized that this is incredibly short-sighted. If a monopolist extracts maximum profits, they are basically hanging a giant neon sign that blinks, "Come take my profits."
It acts as a massive magnet for potential entrants. So under limit pricing, the incumbent deliberately sets its price below that profit-maximizing level.
But the crucial detail is that they don't just lower it arbitrarily. They set it precisely at a level that is just low enough to make entry unprofitable for a new player.
And you have to connect this back to our discussion on minimum efficient scale. A new entrant usually faces higher average costs than the incumbent.
Because they haven't achieved the same scale, they don't have the established supply chain relationships, and they are lower on the learning curve.
Exactly. The incumbent calculates the entrant's likely average total cost, or ATC. Then the incumbent sets the limit price right at or slightly below the entrant's ATC.
So the entrant runs their financial models, looks at the market price set by the incumbent, looks at their own projected costs, and realizes they will lose money on every single unit they sell.
So they abandon their plans to enter. The incumbent sacrifices maximum short-run profits, leaving money on the table today to ensure long-run market dominance.
They guarantee they own the table tomorrow.
But, and this is a big but, Bain's model rests on a very specific, somewhat fragile psychological assumption. For limit pricing to work, the entrant has to believe that the incumbent will keep the price low even after the entrant enters.
And this brings in the Silos postulate, named after Paolo Silos Labini.
The Silos postulate is absolutely critical. It is the assumption made by the potential entrant that the incumbent will maintain its pre-entry output level in the post-entry period.
Let's walk through the game theory of why the entrant makes that assumption and what it implies. Imagine the incumbent is producing 10,000 units. The entrant is considering coming in and producing 2,000 units.
Okay.
If the entrant believes the silo's postulate, they assume the incumbent will stubbornly keep producing 10,000 units.
Which means total market supply jumps to 12,000 units. And according to the law of demand, that massive influx of new supply will crash the market price down even further,
Pushing it deeply below the entrant's cost of production. It guarantees devastating losses.
Yes. But what if the entrant does not believe the silo's postulate? What if the entrant thinks the incumbent is bluffing?
The entrant might reason, if I enter with 2,000 units, the incumbent won't want to crash the price and destroy their own profits. They're rational.
They will accommodate me. They will cut their own production to 8,000 units, so the total supply stays at 10,000, the price stays high, and we both make money.
If the entrant believes that, limit pricing fails entirely. The entrant jumps in, knowing the incumbent will move over and make room on the bench.
Exactly. So the core challenge for the incumbent is making the silo's postulate credible. They have to convince the entrant that they will absolutely not back down, that they will not accommodate, and that entry will result in mutual destruction.
We will talk about how they prove that in a moment. But first, we need to draw a sharp legal and theoretical line. How does limit pricing differ from predatory pricing? Because, colloquially, people use them interchangeably.
They do, but they're entirely different strategies, especially in the eyes of competition law. Limit pricing is a defensive mechanism set pre-entry to deter a potential rival from ever showing up.
The price is lowered, but, and this is key, it is almost always still above the incumbent's own average total cost.
Right. The incumbent is still making a profit, just a slightly smaller one than they could as an unconstrained monopoly.
Predatory pricing, on the other hand, is an offensive, deeply aggressive weapon used post-entry. The incumbent slashes prices below their own average total cost, and often bets to their average variable cost.
Their goal is not to deter a ghost. Their goal is to financially starve and bankrupt an existing rival who is already in the market.
They are willing to hemorrhage their own cash, taking massive losses because they have deeper pockets in the startup. They bleed the startup dry, wait for them to declare bankruptcy, and then immediately hike prices back to monopoly levels to recoup their losses.
Because of that dynamic, predatory pricing is explicitly illegal under most competition laws. It is an abuse of dominance designed to destroy competition, not compete on merits.
And regulators and courts use specific tests to determine if a price cut is competitive or predatory. The most famous is the Arita-Turner rule, which is prime exam material.
Yes, Philip Arita and Donald Turner proposed that a price should be presumed lawful if it is at or above the firm's short-run marginal cost.
However, because marginal cost is notoriously difficult to calculate from accounting data, they used average variable cost, or AVC, as a proxy.
If a dominant firm prices below its AVC, it is conclusively presumed to be engaging in predatory pricing.
Let's make sure we separate average total cost from average variable cost here. Average total cost includes fixed costs, like the rent on the factory, the insurance.
Right. Average variable cost is just the cost of the raw materials and the hourly labor needed to produce one more unit.
So if a firm prices below its average total cost, it might just be going through a tough quarter trying to move inventory. But if a firm prices below its average variable cost,
it means that for every additional unit they produce and sell, they are losing more money than if they simply shut the factory down and went home.
the only logical reason a firm would ever sell below ADC is if they are intentionally trying to murder a competitor. It is irrational in any other context.
But this brings us back to the game theory problem. If an entrant knows the incumbent is losing massive amounts of money during a predatory price war, why wouldn't the entrant just wait it out?
Right. The incumbent is bleeding cash. If I'm the entrant, I just pause production, wait for the incumbent to tire out, and then restart.
Exactly. So how does the incumbent convince the market they are crazy enough or committed enough to sustain those losses?
This is the crux of modern industrial organization. Credible commitment devices. Talk is cheap. A threat is only a threat if it is credible.
To make the threat credible, the incumbent has to tie their own hands. They have to change their own physical payoff structure so that fighting is their only logical option.
And one of the most effective and honestly fascinating ways to do this is by holding excess capacity.
Let's dive into excess capacity. To a layman, building a factory that is 30% larger than you need and just leaving assembly lines sitting idle sounds like terrible management.
It sounds profoundly inefficient.
It is inefficient from a short-run accounting perspective, but it is strategically brilliant. It is the ultimate commitment device. Let's use a poker analogy.
A Vancouver.
It is like walking into a high-stakes poker game and seeing the guy across the table sitting with a mountain of chips that he isn't even playing with. He doesn't have to go all in to scare you.
Just the physical presence of those chips proves that he has the capital to bankrupt you if you try to bluff him.
Precisely. So how does that translate to an empty factory line?
Maintaining excess capacity signals to the potential entrant. Look closely at my balance sheet. I have already spent the sunk capital. The machines are bolted to the floor. The power is connected.
If you enter my market, I do not need to spend 6 months building a new factory to retaliate. I have the immediate, frictionless, physical ability to turn on those machines.
I'll flood the market with supply and crash the price down to my near-zero marginal cost without breaking a sweat. That perfectly grounds the boiling oil analogy.
Right. I don't just have boiling oil. The cauldrons are already built, the fires are lit, and I've already paid for the oil. Stepping up to the wall costs you everything, but pouring the oil costs me nothing.
It turns a hollow threat into a credible, terrifying reality. It forces the entrant to believe the silo's postulate.
Exactly. The excess capacity makes the threat to expand output post-entry completely credible.
And that pretty much concludes our look at how incumbents deal with actual competitors or imminent threats through structural and strategic barriers.
But the evolution of industrial economics took a really radical turn in the 1980s. Economists started asking a seemingly absurd question.
What if an incumbent's pricing behavior isn't driven by actual competitors at all? What if it's driven by the ghosts of competitors?
The ghosts of competitors. This brings us to the final major theoretical framework and the absolute focus of the 2024 IES paper, Baumol's theory of contestable markets.
William Baumol, along with Panzar and Willig, published this theory in 1982, and it completely upended the old SCP paradigm we talked about earlier.
Up until Baumol, the entire field believed that to get competitive pricing, where price equals average cost, allocative efficiency is achieved, and consumers are protected, you needed a market structured with many actual physical competing firms.
You needed an oligopoly or perfect competition.
But Baumol said, not necessarily. He argued that you could look at a highly concentrated market, even a pure monopoly where only one firm exists, and still get perfectly competitive outcomes.
The structure doesn't matter as long as the market is perfectly contestable.
Let's define the strict conditions that make a market perfectly contestable. There are two primary requirements. First, there must be absolute free entry and exit. No regulatory barriers, no licensing requirements.
And second, and this is the absolute linchpin of the theory, there must be zero sunk costs.
Let's ensure we understand zero sunk costs. A sunk cost is an investment you make to enter a business that you can never recover if you leave.
Right, so zero sunk costs means that if you buy $1 million worth of equipment to enter a market today, you can decide to leave the market tomorrow and resell that equipment for exactly $1 million.
You lose absolutely nothing in the exit process.
If those two magical conditions hold free entry and zero sunk costs, Baumol introduces the revolutionary mechanism of hit-and-run entry.
Hit-and-run entry operates kind of like a financial arbitrage. Imagine our monopolists. They have no actual competitor, so they get greedy. They raise their prices above average cost to earn supernormal monopoly profits.
Under Baumol's theory, the second they do that, an entrepreneur spots the profit opportunity. Because there are no barriers to entry, the entrepreneur instantly swoops into the market.
And because there are zero sunk costs, they can match the incumbent scale immediately.
The entrant undercuts the monopolist's high price by just a fraction. Consumers flock to the entrant. The entrant steals the entire market and reaps the supernormal profits.
Now, the incumbent monopolist isn't just going to sit there. They will eventually react. They'll drop their own prices to match or undercut the entrant to win their customers back.
But here is the beauty of the hit and run. The very second the incumbent drops their price and a price war looms, the entrant just leaves.
They hit and they run.
Because there are zero sunk costs, the entrant has zero risk of being trapped in a predatory price war. They sell off their assets at full value, pocket the massive profits they made during their brief stay, and disappear.
And here is the profound conclusion of the theory. Because the incumbent monopolist knows this hit-and-run attack could happen at any second, the mere threat of potential competition acts as a brutal disciplinary force.
To avoid attracting these hit-and-run ghosts, the incumbent is forced to proactively keep their prices down at the competitive level where price equals average cost.
It is brilliant. They achieve competitive efficiency without any actual structural competition. The ghost of the hit-and-run entrant forces the monopolist to behave as if they are in a perfectly competitive market.
From a regulatory standpoint, this was explosive. The Chicago school loved it because it provided a theoretical justification for massive deregulation.
It suggested that antitrust regulators shouldn't obsess over HHI or breaking up monopolies. As long as a government removes regulatory barriers to entry and exit, the market will police itself through contestability.
And we actually saw this put into practice, didn't we? The classic real-world test case for contestable markets was the U.S. Airline Deregulation Act of 1978.
Yes, the airline industry was initially heralded as the perfect contestable market. Think about it. What is an airline's capital asset? An airplane.
An airplane is literally capital with wings.
If an airline notices that the route from New York to Chicago is highly profitable because an incumbent is charging monopoly prices, they can simply fly their plane from another route over to Chicago.
They hit and run the market, and if the incumbent fights back, fly the plane away. The airplane is not a sunk cost, it is highly mobile.
It sounds perfect in theory, but we have to point out the fatal flaw, and this is exactly what the examiners will want you to critique. The airline industry did not remain perfectly contestable, did it?
No. Prices did not stay perfectly competitive, and monopolies were formed around hub-and-spoke models. Why?
Because of the ubiquity of sunk costs. You are right, the airplane is mobile, but operating an airline requires immense sunk investments that cannot fly away.
Like gate leases at airports, which are fixed and often monopolized by incumbents.
Advertising campaigns to tell customers you are flying a new route are completely sunk. You cannot unspend marketing dollars. Establishing a ground crew and maintenance logistics network requires unrecoverable time and capital.
To ground this with an analogy, think of setting up a street food cart versus building a blast furnace.
Yeah.
If you buy a hot dog cart, sell hot dogs for a day, and then decide you hate the food business, you can sell that cart tomorrow to someone else for almost exactly what you paid.
That is a highly contestable market with near zero sunk costs.
But if you pour $50 million of custom concrete to build a steel plant, that money is gone forever. If you try to run, you leave the concrete behind. The risk is immense.
And the moment sunk costs exist, hit-and-run entry becomes impossible. The entrant cannot simply flee without taking a massive financial hit. They are trapped.
Because they are trapped, the incumbent knows the entrant has too much to lose. The disciplinary threat of the ghost evaporates.
The incumbent can safely raise prices, ignore the threat of entry, and exercise monopoly power. While Baumol's theory is a beautiful, mathematically elegant benchmark, the absolute requirement of zero sunk cost severely limits its practical application in heavy industries.
Okay, let's bring this all back to base camp. We've covered an immense amount of theoretical and applied ground. Let's synthesize this directly into your ultimate goal, passing the IES GE-03 exam.
Based on the historical progression of the papers, specifically moving from contestable markets in 2024 to limit pricing in 2025, we have synthesized the 3 most likely patterns you need to prepare for in the upcoming 2026 exam.
Okay, prediction number 1. Be ready to execute on market concentration metrics, specifically calculating and interpreting the HHI.
Do not just memorize the sum of squares definition. Be prepared to work through a hypothetical merger scenario, calculate the pre- and post-merger deltas, and critically link that result back to the SCP paradigm versus the DEMSET's efficiency critique.
Right, like, can you explain why a regulator might block a merger and why a Chicago school economist might defend it?
Prediction number 2. Deep analytical evaluation of strategic conduct, particularly limit pricing. You must be able to articulate Bain's model and explicitly define the role of the silos postulate.
The exam will likely ask you to evaluate the core trade-off. So walk the examiner through exactly how the incumbent sacrifices short-run price maximization for long-run deterrence.
Furthermore, be prepared to contrast this with predatory pricing, specifically utilizing the Arita-Turner average variable cost test.
And prediction number 3, a critical takedown of contestable markets. Do not just praise Baumol's theory. Define the strict conditions required. Absolute free entry and zero sunk costs. Explain the hit-and-run mechanism and then critically dismantle it.
Explain how the presence of real-world sunk costs, using an example like airline gate leases or massive advertising budgets, invalidates the theory and restores monopoly power to the incumbent.
If you can master those 3 areas, connecting the mathematical metrics to the structural theories and explaining the strategic conduct firms use to manipulate those structures, you will be in an exceptionally strong position for the industrial economics portion of the paper.
You will be proving that you understand the moving parts of the system, not just the vocabulary.
So to wrap up this deep dive, I want to leave you with a thought experiment to mull over on your own as you study. We have spent a lot of time talking about steel plants, blast furnaces, and physical barriers. But industrial economics is constantly evolving. What about today's digital economy?
That is the absolute frontier of modern antitrust and industrial organization. The rules are being completely rewritten.
Think about building a massive software platform, say a global social network, a search engine, or an AI infrastructure platform. The upfront R&D costs are astronomical.
But once the code is written, replicating it, serving the 1 billionth user, costs almost exactly zero. The marginal cost is practically non-existent.
Furthermore, these platforms have extreme network effects, acting as massive structural barriers. But they have near zero physical sunk costs to scale globally. So, look at those castle walls.
If a digital platform has extreme network effects but zero marginal replication costs, what is it?
Is it a dangerous monopoly requiring aggressive SCP-style regulation to protect the consumer from data extraction? Or is it a perfectly contestable market, just waiting for the next hit-and-run disruptor in a garage to write a slightly better line of code?
Keep an eye on those dynamics because that is exactly where the field is heading next.